right, looks like we've got a good number in, so we're going to go ahead and get started. Welcome, everyone. I'm Ryan Green, and I'm joining James Blake. We're advisors with Brand Asset Management Group. And first of all, we just wanted to thank each of you that's joining us live here this morning, and as well as anybody else that's joining us in the recorded version of this when it's available. Welcome, whenever that might be. We're glad to have you joining us and participating in today's presentation, which I think will be of interest to many of you. Today, we're going to be covering, at least at a high level, the most impactful aspects of what's being called the Secure Act 2.0. And anytime there's a new law that's passed, it's very important to have a good understanding of potential pitfalls or changes that need to take place within your own planning, but also any new planning opportunities that new law might present. And Secure Act is no different in that regard. There's a multitude of things that it covers, fairly in depth around a lot of different topics. So again, there are quite a few new planning opportunities that are available, and we're going to do our best to cover all of those today. I first do want to point out, though, is that this particular bill is from a 4,000-page document. It has oodles and oodles and oodles and oodles of stuff in it. We're not going to be able to cover in depth every single aspect of Secure Act 2.0. We've done our best to try to kind of synthesize that down into, again, what may be the most impactful things. They're going to impact the most of our clients. But certainly as we move through today's presentation, if you're thinking of things or you heard about things in Secure Act 2.0 that we don't get to today, and you might be wondering how those impact your specific situations, please do feel at liberty to reach out, and we'll be happy to address any questions you may have. Now, before we get into today's material, got a little bit of housekeeping we need to do. The first item is that this presentation should be considered to be for educational purposes only. What we covered today should not be construed as investment, tax, or estate advice. Also wanted to point out that as we go along through the presentation today, if you have questions, we will try to leave time at the end of the presentation to try to answer some of those. If you look towards the bottom of your screen, you should see a little Q&A icon that you can hit. That'll give you the ability to type in questions that we'll see on our end. We'll make note of those, and we'll circle back towards the end of the discussion to cover as many of those as possible. All right. So now, without further delay, let's go ahead and get into today's presentation. So pulled this cartoon here, and I thought it'd be worthwhile to kind of replay the tape just a little bit, go backwards, as it were, before we go forward. And in 2019, specifically December of 2019, the Setting Every Community Up for Retirement Enhancement, or Secure Act, was passed. And the cartoon here, I just find it amusing because while it sounds really positive, retirement enhancement, who doesn't want retirement enhancement? It also was fairly overt in its method of accelerating potentially some tax revenue for the government, and hence the picture here of the fox building the hen house. And while Secure Act 2.0 has many positive developments in it, there certainly is an additional element of, is this a way to enhance or accelerate at least some potential tax revenue, which if you haven't been paying attention, the government kind of needs that because, well, I won't go into that right now, but let's suffice it to say that they're interested in generating as much tax revenue as they politically popularly can at any rate. So at the highest level, I just think it's worth pointing out that Secure Act 1.0, I think, had a much broader impact on many more people. And I say that because the Secure Act was most known for doing two things. The first was that it pushed the required minimum distribution age out a little bit, which Secure Act 2.0 also did, and we're going to cover that as we get going today. But more notably, it eliminated what's called the stretch provision. And what that means is that prior to the passing of the Secure Act 1.0, a non-spouse IRA or 401k beneficiary had the ability to stretch distributions from that inherited account over their own life expectancy, which in effect provided potentially many more years to draw a taxable IRA down and spread that tax impact out significantly in some cases if it was a younger beneficiary. Well, Secure Act 1.0 killed that. basically said that most non-spouse IRA or 401k beneficiaries have to have that account fully depleted, withdrawn, and taxed within 10 years, which obviously accelerates a significant amount of the tax due on that balance. And there's also an impact on Roth beneficiaries. Now, while it's true that Roth IRAs and 401k distributions aren't taxable, there is now this still requirement to have that Roth fully depleted within 10 years, which means that you have less years to afford tax-free growth. So even if you're not paying tax, there still is an impact there. So that had a broad impact because anybody that leaves an IRA or a Roth to their kids potentially could be impacted by the removal of that stretch provision. Secure Act 2.0 doesn't really have that one big notable thing that's going to impact, many taxpayers. Rather, it has these little individual provisions that impact people much more specifically. Now, again, as we'll cover, it does actually extend the required minimum distribution starting age yet again. It also affords increased retirement savings for certain people, changes to Roth savings for certain people, enhanced access to retirement funds for certain people. So again, not this big, broad impact, but much more targeted and specific impact to certain people, which in some ways makes the bill more challenging because you need to have an understanding of who specifically is going to be impacted by this multitude of different provisions within the law. So there's a lot here. There's a lot to cover. And James is going to go ahead and get us started by covering some of the changes to those Roth-related savings that I mentioned before. So James, take it away.
Thanks, Ryan. For those of you that don't know me as well as Ryan, I know Ryan has a much longer tenure at Brand, but I'm starting on my 4th year here at Brand. So happy to have the opportunity to speak with you all there. If I do not know you, looking forward to the opportunity to get to know you in the future. So the Roth-related changes that kind of looked at and hopefully we'll do a good job of filtering through the large amount. I think it was 130 pages that this bill actually was, put inside of an enormous spending bill. But the one important thing that I want to point out in the beginning is that there were no restrictions or elimination of any of the existing Roth strategies. Most notably, two of our favorite, the backdoor Roths don't get cut, which they have been on the cutting block we've seen in the past before, and they get taken out of the bills before final approval, thankfully. And then there's also no limits or income thresholds that are put on the amounts of conversion. So two good pieces, and all existing Roth strategies are still there. It's also our opinion that there's a significant number of changes that are either neutral to good. That's not to say that there's not a couple of tax grab scenarios where we'll kind of go through. And as that original cartoon or picture alluded to. But for the most part, we do think this provides a lot of additional opportunities for good planning. So we decided to start our discussion with the employer retirement plans, which are really Roth 401k and Roth 403b. There's other ones, but those are just the most common that we'll see. I put there my take on whether they're positive or neutral in the beginning. And then one of the other confusing parts of this act is that everything has, or a lot of them have, different starting enactment dates, just to make it more complex and for you to require even more tax and advisory counsel. But the starting date there of 2024, RMDs are eliminated from plan Roth accounts. For a little context, rolling over plan Roth accounts used to be a no-brainer because individual Roth accounts do not have an RMD or have not had an RMD. And so this change really just levels the playing field. And it's welcome news for providers of those plan accounts. And interestingly, trying to equal the playing field for those two types of accounts has been on the in budget proposals before, twice actually in Obama administration's budget requests. They've wanted to actually add RMDs to individual Roth IRA accounts. So it's a complete 180 from that thought process. And so thankfully RMDs are being eliminated from plan Roth accounts. So that, definitely a positive in that respect. The second bullet point is a pretty exciting option to those that are still employed. So it's a positive. The election to receive additional employer matching contributions on the Roth side of the plan, or the Roth ledger, that continues the theme of opening access to more dollars getting into Roth accounts. So that's definitely a positive. And then the last bullet point there, we believe adding a Roth version is more of a neutral. Roth version of a SEP and simple accounts, in my take, is a little bit of a neutral kind of a operational efficiency piece. But certainly if you have access or have opened a SEP account or a simple account and have further questions on it, we'd be happy to discuss those with you. This is probably the change I'm most excited about. I don't know if Ryan agrees. I do believe for the families that we serve and those of you that are listening and have a real interest in multi-generational wealth planning, this to me is something that Secure 2.0, it's a good opportunity, a good planning opportunity there. So I definitely think it's a positive starting in 2024. I have limited there because there are certain conditions that must be met to allow for those. So a quick rundown of those conditions are the receiving Roth IRA has to be in the name of the 529 beneficiary, and the 529 plan must be maintained or open for 15 years before any of the conversion or any transfer would be eligible. The actual contributions and the earnings that are associated with those contributions have to marinate for 5 years. So there's a 5-year rule before those are eligible to be transferred. And then there is an annual limit on the transfers from a 529 account to an IRA. They happen to be the same as the regular limits to IRA or Roth IRA contributions, which depending on your age is either $6,500 or $7,500 today or in 2023. And then the last condition that we'll mention is the maximum lifetime amount of the transfer is $35,000. So if you have an annual limit and a $35,000 max that you can transfer, once you start making these transfers, as long as you continue to have that compensation to make it eligible, you can do this in about 4 to 5 years and get the $35,000 put over. And that's if there's no other increases to the annual limit that you can put into IRAs or Roth IRAs. So a little bit more on the planning opportunities. Like I said, this is what I'm most excited about. We will need to have more confirmation that a change in the beneficiary will not upset that 15-year maintenance. But it does look like that's the case, that it appears a parent could, for instance, go, if the dollars are not needed, all the dollars are not needed in a 529 account for education, that the parent could change the beneficiary of the 529 plan to say themselves, and then transfer those dollars, those amounts into their own Roth IRA. As long as they follow the other conditions. Another strategy that could be used, it would be what we call priming the retirement pump for the children and or grandchildren, which if you picture a scenario where a significant contribution is made into a child or grandchild's 529 account, maybe around when they're born or sometime in their first 5 years. And then when they turn 20, 22, whatever that might be, that account has then met the 15-year rule. As long as there's compensation from that child, which another reason to push that child maybe to get a job and to earn some compensation. But as long as there's compensation, then transfers from that account could begin. And if you can do $6,500 or $7,500, depending on what the amount will be at that time per year, and you can get that in 4 or 5 years, you can imagine with a expected return that's not unreasonable. You can imagine by the time they're 65, that Roth account could very well exceed $1 million. And so that's obviously, for a multi-generational thinking family, that's a pretty big opportunity. And that's assuming that there's no other contributions or conversions that are put into the account. So I think a very significant opportunity and something we're excited about. On this part, this is one area of the law where it seems to take the decision from us. So mandatory Rothification of catch-up contributions. will be required if the prior year's wages are greater than 145,000. So I personally, I find it difficult to interpret this as anything but as a grab for tax revenue. But it does apply to catch-up contributions in a 401k, a 403b, and government 457 plans. There are some increases in IRA, catch-up contributions for IRA and traditional individual accounts. This does not apply to those. So it's really neutral to negative for most high wage earners starting in 2024. The precise language of the catch-up provisions, it does actually mention wages and not self-employment income. So there could be some planning opportunities for those that get self-employment income and not wage income. And then it begs the question that what if your employer does not offer a Roth option? You're required to make Roth contributions with those catch-ups, and you know it is some employers do not have a Roth option for their 401k. What do you do? And it's pretty clear in the legislation that if there is no Roth option, then there can be no catch-up contributions for anyone in the plan, and that would include anyone that's making under 145,000. So that, as if you're a business owner, that could be a significant. You could really there could be a lot of people that could be upset about that if you eliminate their ability to add more to the retirement savings. So I think a lot of employers will look at that and try to make a Roth option available. At this point, probably a good time to transition back to you, Ryan, to talk about what is likely to be the most headline change to the Secure 2.0, which is the delay of that R&D again.
Yeah, in fact, thanks, James. I was just going to say this is probably the most headline thing that you've seen under the Secure Act 2.0 if you've been paying attention. It's a thing that is kind of here and now for a lot of people, and just kind of to round this out a little bit. So when we talk about RMD, required minimum distribution, that's really the beginning of you being forced to take a minimum amount out of your retirement account each year. Idea being the government has given you a tax incentive to fund this account, and it's grown tax deferred. You haven't paid any tax on it over all the years. And finally, they're saying, okay, enough's enough. Now we want to get some tax revenue. So we're going to make you take a certain amount out of your retirement account each year. For 30 years, over 30 years, that age was 70 and a half. In fact, when they invented the required minimum distribution, it started at age 70 and a half, or technically the year in which you turn 70 and a half, because of course it can't be easy. It's been that for over 30 years until the Secure Act 1.0 moved that from 70 and a half to 72. Well, the Secure Act 2.0 has delayed it again. But it's done it kind of in stages for people of different ages. The easiest way to look at it is the table here, and it basically says that if you were born between 1951 and 1959, your required minimum distribution starting age is now 73 instead of 72. Furthermore, if you were born in 1960 or after, it is 75. This is a positive in a lot of ways. Most notably because it affords more tax planning flexibility. For example, if you're interested in Roth conversions, it gives you more years to potentially execute Roth conversions at a better tax rate because your overall income will be lower without the mandated distributions coming from the IRA. So I would say all around this probably is a positive. Because we always get this question, well, what if I already started taking my required distributions? Does this impact me? And the answer is just like 1.0, nope. If you're already taking your required minimum distributions under the old rules, you're not impacted whatsoever. Everything's going to stay the same. Another question is for those that are still working past required minimum distribution starting age. If you're still working, even if you're of the age to take required minimum distributions, in most cases, you don't have to take an RMD from that retirement plan that you're contributing to, unless you own 5% or more of the company that you're working for, in which case you do have to take a required distribution. And the same age parameters apply to that specific situation as well. So, in case you haven't figured this out, the rules surrounding retirement account contributions and withdrawals are just a little bit complicated. And unfortunately, people do tend to make mistakes. And the Secure Act 2.0 really does provide some additional language to try to make that just a little bit more livable. The first of which is related to required minimum distributions. If you miss the deadline, which is generally the end of the year, you have to take that required minimum distribution out. To the extent you don't take any or all of it out, up until this point, there's been a 50% penalty on any undistributed amount, which is a pretty hefty penalty. So they really want to make sure you're taking your RMDs. But the new law reduces that from 50 down to 25. And you can further reduce that to 10% of the undistributed amount as long as you address that during what they call the correction window. And that correction window starts January 1st of the following year, really the first day after you miss the deadline, and ends the earlier of you receiving written notice that you're in delinquency when tax has been assessed for the delinquency, or January 1st of the following year. So at the end of the next year after that. After that, the correction window is closed. So hopefully you never miss your required distribution, but if you do for whatever reason, it's generally recommended to try to correct that as soon as possible to hopefully mitigate that penalty just a little bit. In addition to that, they made some changes to the statute of limitations on excess funding, which is really an undistributed required distribution amount or a contribution to a retirement account that you weren't eligible to make for whatever reason. The old rules tied the clock ticking for that statute of limitations to when you file Form 5239, which you only file when you realize you've made a mistake, which you have no reason to file if you don't realize you've made a mistake. So if you don't realize it, the statute of limitations used to just kind of tick on permanently, but now they've tied that to when you file the 1040. So when you file your tax return, basically. If you don't have to file a 1040, it would be the regular tax filing deadline for that year. And in case you're curious, that statute of limitations is 3 years for required distributions and 6 years for excess contributions to retirement accounts. In addition to that, they also, I wouldn't say relaxed, but further clarified the rules around prohibited transactions. This happens when you execute a prohibited transaction in a retirement account. It basically disqualifies that account and really renders it subject to full taxation of the entire balance, which is a big deal. Don't do that. But if you did, the rule clarifies that prohibited transaction only spoils that specific account. So if you have multiple IRAs, only the IRA that executed the prohibited transaction is disqualified. So that's the way that it's been enforced for years, but this really kind of clarifies it and puts it into black and white for people. So around qualified charitable distributions, little tweaks there in the new law. So qualified charitable distributions, or QCDs, are direct gifts from an IRA to a qualified charity. And these are handy because you can receive a tax benefit for making this gift from your IRA without the need to itemize on your tax return, which can actually result in fairly meaningful tax savings depending on your situation, since we've been operating with a larger standard deduction starting in 2018 under the Tax Cuts and Jobs Act. So it's got that positive. It also can reduce your overall gross income, which actually can result in a reduced Medicare premium, among some other things, taxability, Social Security, amount of medical deductions, and some other stuff there. So QCDs can be a very good planning opportunity for many taxpayers. They did not change the age. So despite moving the RMD age out, didn't actually extend the QCD age. It remains at 70 and a half. And unlike the old time frame when you started an RMD, the year in which you turned 70 and a half, this actually is literally when you turn 70 and a half. So not the year, the actual date you literally turn 70 and a half. So just kind of a little FYI on that one. And so the age stays at 70 and a half, but they are going to finally adjust the maximum annual amount, which has been $100,000 per IRA owner for as long as it's been around. They're finally now beginning in 2024 going to allow that amount to adjust annually for inflation. So that'll be a pretty good thing for those that have large IRAs and are highly donative and want to give more than 100,000. You'll be able to going forward. A little bit more esoteric, but there is now a specific provision that allows a one-time QCD to what's called a split interest entity. These would be things like a charitable remainder unit trust or CRUT, or a charitable remainder annuity trust or CRAT. Then they also have these giving annuities that you can fund with, which all this on the surface sounds like a really positive development. Unfortunately, they've restricted in a way that I think is going to severely limit the applicability, especially for the CRUTs and the CRATs. Those are kind of expensive to create and maintain, and to do one of those with a $50,000 balance really just doesn't make sense for most people, and I doubt many people are likely to undertake that. The charitable giving annuity, that could be a little bit more of a possibility because those are actually created by the charity. Therefore, the administrative element of it is removed. So could be of interest there for certain people. If you're interested in one of those types of arrangements, that's probably one of those things where we'd be happy to have a one-on-one discussion with you and talk about how that may or may not fit into your plans. But at least there's some additional planning flexibility there. We've also got some beneficiary changes, and I know this has been said several times, but just to say it one more time, Secure Act 1.0 now forced this 10-year max payout, eliminated the stretch provision. Secure Act 2.0 did nothing to change that, unfortunately, but did make some specific changes. One clarification, and I would say one change. The clarification around what's called applicable multi-beneficiary trust rules. These don't have a high degree of frequency, but are very important when it does make sense. So the scenario might be you've got an IRA and a special needs son or daughter, and you want to make sure that that IRA, when you pass, goes into a trust that specifically benefits that special needs situation. And if that full balance wasn't consumed by that special needs beneficiary, let's say you don't have any other kids and you might want the rest of that to go to a charity or charities when the special needs a person passes away. Well, there was a time when if you set things up that way, it would actually result in that special needs beneficiary being forced to take that 10-year payout, which I know we said, well, wait, doesn't everybody have that 10-year payout? No, most do. But in cases of disability, like a special needs situation, the stretch does still exist. So this new rule clarifies that you will be able to leave your IRA to a special needs trust that then can support a charity at the end without blowing up that stretch provision for the special needs beneficiary. So that's a good thing. Again, not that that happens a lot, but it's really good that you can do that in the right situation. There's also one more option because they don't have enough already for spouses. So if husband or wife passes away, surviving husband and wife has a multitude of options at that point. You can roll over that into your own IRA. You can just treat it as your own, but separately. You can remain the beneficiary of that. Those are all options that you have currently, but starting in 2024, there's going to be a new option. And that allows the surviving spouse to be treated for taxability purposes as the deceased spouse, which may not make sense at first, but when you think about a specific situation where, let's say, of husband and wife, the first to pass away is a much younger spouse. The older surviving spouse may want to elect that option because that could give you the ability to delay RMDs or reduce RMDs, again, because of the younger age of the deceased spouse. So just another level of planning flexibility there to consider. Also, some changes to the catch-up provisions. James briefly mentioned these earlier. The first of which to cover is that beginning in 2024, the catch-up amount for IRAs and Roth IRAs does begin to get linked to inflation. It's been 1,000. The catch-up amount has been at 1,000 for years, I think since 2006. And it's just kind of sat there. It's never gone up. It's now finally going to start to move up again, index with inflation, which means we get to keep track of $100 incremental increases to the catch-up amount, which just adds to the fund, but seriously does allow you to get some additional money into those accounts. So that's something that we'll be watching. Additionally, in 2025, there are some catch-up changes to employer plans for specific ages only, which is very, very fascinating to me that only those age 60, 61, 62, and 63, just that demographic can have an enhanced catch-up amount for 401ks, 403bs, That would be the greater of $10,000 or 150% of the prior year catch-up amount. Or for simple IRA owners, that would be an increase to $5,000 or 150% of the prior year catch-up amount. And then as James mentioned, just to say it again, the 24 plan catch-up amounts, if your wages are over 145,000 for the prior year, those are going to be required to go into the Roth bucket, which is a way to enhance tax revenue, but is also a way for individuals in that situation to get a little bit more crammed into the Roth side of things, which could be beneficial in its own right. Now, there's a lot of other 401k changes in addition to that, and James is going to walk us through some of those now.
Thanks, Ryan. This first list, starting with the student loan payments, employers will be allowed to amend their plans. This is a good update. They'll be allowed to amend their plans to allow matches and non-elective contributions to go towards the young worker who is putting money towards their student loan. So if they're prioritizing trying to get out of debt, and that is limiting the amount that they can then put in, or they're not even able to put anything into their 401k plans or their 403b plans, employers can now, like I said, amend those plans to where the student loans count. And so they'll get a certain percentage that is tied to those student loan payments. So I think a positive there on the student loan side. It will probably, for those of you that are listening, most relevant to the business owners and executives, because I think it'll be a good way for you to attract young talent to go ahead and amend those plans. You can attract and retain them by giving that, what is a bit of a benefit there. As far as the next bullet point, first year solo 401ks, this is similar to what's been around for available for SEP IRAs. But you can now set up and fund a solo 401k from your previous year's income up until the tax deadline. Now, you cannot have it with an extension, so it's just the April deadline, but you now have that ability as a sole proprietor to kind of doesn't have to be a end of the year decision. It can be, as long as it's prior to your tax deadline, you have a little bit more flexibility with that. And then the last piece there, similar to the student loan provision, for those young workers that are trying to prioritize building some emergency savings, which is certainly a good thing. This is a linked emergency savings account that's specifically linked to the employer plan. And so you'll be able to pull money from there without any tax or penalty when you're distributed. It's just only up to $2,500 that can be put in there. But that $2,500 then counts towards any matching or non-elective contributions that the employer has. So again, it doesn't, the young worker who want to prioritize that emergency savings won't miss out on some of the match. The next 3 slides or so, I'm committing a violation of the interesting presentation law by throwing way too much data on a slide. But as Ryan said, in a 130-page document, the intent of this is not to go through every one of these bullet points and give you a full explanation. But we do, since this is going to be recorded, you'll have access to these slides. We do want to provide each of these because there's a good chance that 1 or 2 of these bullet points will actually make sense to your specific situation, or maybe a loved one's, a family member's situation that you can share. And so if there's questions, or it does make sense for you to dig a little deeper and want to know more about any of these, we want it to be available. We want you to be able to reach out to us with any of these. I will quickly go through some of these. The expanded list of exemptions for a 10% early withdrawal penalty. So it may be well known that if you pull money out of a retirement account prior to age 59 and a half, there is both the tax you have to pay on it, but also this 10% early withdrawal penalty. So there has been an age 50 exemption for people that have really difficult, stressful jobs that do a separation of service after age 50. And then they no longer they can get to their retirement accounts if they're a firefighter. This adds that exemption to include private sector firefighters, state and local correction officers, and then qualifying workers with 25 or more years of service. It seems to indicate that the 25 years of service is with one employer. I don't know if there'll be clarification as long as you're with in the industries that they're looking at, these hard-working jobs that create a lot of stress, and you may want to retire a little bit early. Maybe it's multiple employers as long as you have 25 years of service. But so far it looks like it's leaning towards one employer. The qualified disaster recovery distributions is just permanently reinstated. Unfortunately, the max is only 22,000 instead of what it was 100,000. But it doesn't have to be reapplied for every time. Terminal illness is there's just a broader definition, a longer definition that used to be a terminal illness had to be within 24 months. A doctor had to say that you were reasonably facing a death within 24 months, and this is now extended to 7 years. And then victims of domestic abuse. There's a very broad definition for domestic abuse, which is good. And then it is a limited amount, lesser of 10,000 or half of your vested balance. So essentially no more than 10,000 can be pulled out for a victim of domestic abuse. A very small amount for an emergency withdrawal is added. You can only do one time per calendar year with $1,000 cap, but it is something for people that don't have an emergency savings that's built up. And then the last bullet point for qualified long-term care distributions to pay for an insurance premium payment up to 2,500, forgive me, 2,500 to pay those premiums. You can be pulled out without an early withdrawal penalty. So those are some of the ones there. Again, there's a plethora of plan-related enhancements. Just wanted to throw out some of these more so you can look back at these, but many employers will be required to include an auto enrollment. The actual participants can elect out of that, but the employers will now require. Some of them already do, but they will now be required. A good piece is this retirement plan startup credit. Before it was 50% of the startup costs could be credited back. Now it's up to 100% of plan startup costs. So you can see that there are some parts of this act that are positively reinforcing small businesses to start up more plans, to make it easier, to make it less costly, and those are a few of those. The multiple employment plans now are eligible for that startup credit, and then an additional credit is available for those employers that offer military spouses special benefits. So all things I think are positive there. Again, we're a lot of information. Really just want this to be there for you for reference. Employers with simple plans are able to increase the non-elective contributions. You can create a SEP IRA for any household employees that you may have, if that helps you to, be the best offer for, potentially a nanny or someone else that be working in your house. And then small business owners get yet another option for their employees called a starter 401k. It's essentially very cost effective, and it is only employee deferrals that go into it. It's like a individual IRA that is attached to your wages and to your payroll. So another good advancement there. More part-time workers will be considered mandatory participants in a 401k. What this means is that it makes it easier for part-time workers with less than 1,000 hours to be allowed into a 401k plan. So changing gears, this is not too much information here, but these are pretty significant changes that are positive for the care of the disabled. And so I wanted to make reference to these. In 2026, there's expanded access to ABLE accounts. For those that are unaware of what an ABLE account is, it's a tax advantage savings account that does not eliminate eligibility for SSI, Medicaid, and means tested programs. It's primarily important for additional help beyond like anything other aid that they're getting. And what this does is, prior to this law, you had to be injured prior to age 26. This extends it prior to age 46. So you get a 20-year window, more opportunity for if that disability occurs. And where I think that is really effective is with any mental health issues that could cause you to be disabled. Those happen, a lot of those happen after age 25. So this just opens up to some of those mental health issues that could occur. And so I see that only as a positive. And then disabled first responders. I don't know why it's taking until 2027 for this to become enacted, but what this change does is current law, I'm sorry, the prior law said that a disabled first responder would get a disability pension payment that was not taxable income. But as soon as they got to their full retirement age, that disability pension payment would become a regular retirement pension payment, which would then be taxable. So depending on when they were injured, for a certain amount of years, they'd have a tax-free income stream, and then they would immediately be switched and be penalized by becoming full retirement age. This eliminates that. And so it's a significant tax relief for those that are caring for us, the first responders. And it rightly continues the tax-free income stream for life for those that qualify. We mentioned or alluded to in that earlier cartoon, the insurance industry has lobbied strong for Secure 2.0, just like they did for Secure 1.0. So there have been some annuity-related changes, and a few of those I have listed here. One of those being to QLACs, the Qualified Longevity Annuity Contracts. What those are, QLACs are a deferred annuity that's purchased in a qualified account in a retirement plan, essentially. And as long as it follows IRS requirements, the RMDs associated with it are deferred until age 85. That's the basic definition of those. What this law does is it repeals a 25% account balance limitation, and it also allows you the maximum amount that can be invested into a product like that is now increased to 200,000 versus what it would be was 155,000. Not a huge change. I personally never recommended one of these products, but that does not mean it wouldn't make sense for someone's particular situation. And then income annuities held within qualified accounts. This just means that those income annuities are now able to offer additional benefits without violating the IRS rules. The additional benefits are available for non-qualified annuities that you could purchase. They mainly have to do with the income streams and any lump sum payments, but I'll run through it real quick. It's guaranteed increases of income payments, lump sum payments, acceleration of payments, and then dividend-like payments, and then offering a return of premium death benefits. So like I said, just adding a couple more of the additional benefits that were restricted. And then the last piece there, expansion of eligible investments in VAs and VULs. Really, that's just allowing VAs, variable annuities, and variable universal life insurance products in their sub-accounts. It's allowing them to be invested into ETFs, not just mutual funds. So adding ETFs to the investment landscape, a positive, not probably a huge change, but something that was thrown in there, and that is an addition. So at that point, Ryan, probably a good way to end this would be to say we've said a lot what's included. Maybe some of the important things are what's not included, and maybe what some of the questions that people will have that we'll surely address when we're done. Is, was this included or was that included? And I think Ryan's made a good investigation of what that is.
Yeah, so here's basically the summary of that. And I know we've mentioned some of these, but they are a big deal, at least for us who watches this kind of stuff. Some of these things, every time a new law rolls around, it's always very interesting to see, okay, well, did they eliminate the ability to do that? And one of those is in the case of what we kind of colloquially refer to as backdoor Roth funding, which is a method for making contributions to a Roth when your income is too high to typically allow you to do that. And it involves funneling the money through an IRA, the non-deductible contribution first. A lot of people thought that was going to be eliminated. Ironically, since it's been actually spelled out, like, you can do this, it is okay. So it's really no longer a question anymore, but it's something we pay attention to each time. There was no language in this document, as far as we're aware, that would impact that backdoor Roth funding. Mega backdoor is kind of the same thing conceptually, only that takes place usually in a 401k, where 401ks can be set up to afford participants to make contributions on an after-tax basis that could then be converted over to Roth later on, or immediately if your plan is set up conveniently like that. Benefit there is, and why it's called mega, is because the 401k contribution limit is significantly higher than the regular Roth IRA contribution limit. So if your plan is set up appropriately, that can be highly beneficial to certain people as they plan for retirement and are interested and have the cash flow to get more money into the Roth structure. So nothing in the new law that we're aware of that would impact the ability to do that. So that's certainly a good thing. Also, no changes to who can do a Roth conversion. Some of you may remember, I think it was before 2010, if your income was over a certain limit, you could not do a Roth conversion, which effectively is how they closed the back door, or before the back door opened, I guess is a better way to say it, is if your income was too high to do direct Roth contributions, your income was too high to do a conversion, and so there is no back door in that case. They removed that during the financial crisis as a way to, once again, I think, enhance tax collection. And there's been nothing. People keep waiting for them to put that limit back on. Nothing here that does that. So you still can do a conversion regardless of how high your income is. Mentioned before, no change to the QCD age. That remains at 70 and a half. So that's important. Frustratingly, and this drives me nuts to no end, frustratingly, you still don't have the ability to make a QCD directly to a donor advised fund. People that have donor advised funds really do seem to enjoy the convenience and planning flexibility that tool affords. But unfortunately, you're not eligible to make a QCD into a donor advised fund. If you do, it doesn't count as a QCD and will be considered to be a taxable IRA distribution. Now, it's still a deductible contribution on the other end of it. But again, that could potentially be impacted by whether or not you're taking the standard deduction or itemizing, and it doesn't have that benefit of reducing your overall gross income. So still just frustrating that they don't give you the ability to do that, but it is what it is. And then lastly, the restriction of use of certain private investments in Roth IRAs and regular IRAs. There's nothing in this that further restricts the use of private investments, which is a big deal for some investors. Especially if you've made a private investment that has turned into a very, 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 very large Roth IRA, like Peter Thiel was kind of famous for that happening. He wound up like a $5 billion Roth IRA or something like that. So at this point, nothing that further restricts the use of private investments in retirement accounts. And then as we wind down towards the end here, as is often the case with new law, it's complicated, it's complex, and it's usually layered on top of older, complicated and complex laws that were layered on older, complicated and complex laws. So these things are somewhat difficult and obtuse to understand in the first place. But what makes this bill a little bit more challenging is that it actually takes effect at different times. Different things happen at different times. So this little roadmap will give you kind of an idea on how some of these things lay out going forward. One of the changes was actually retroactive, going back to January of 2021. If you qualified under a disaster distribution provision, your ability to have that exempted from penalty does now go back to January of 2021. Again, not that impacts a ton of people, but worth pointing out. Effective immediately. So the things to be aware of that start right now are that RMD age being pushed back to age 73. The fact that you can now fund SEPs and simples in the Roth flavor, so that takes effect immediately, and that penalty reduction for missed RMDs. Those all happen immediately. 2024 is when the bulk of the planning provisions really do kick in. I won't go through them one by one, but then there are also some trailing things that start in 2025, 2026, 2027, all the way out actually to 2028. So kind of really got to think a little bit ahead as it relates to some of these things. But, as advisors, it is our job to be attuned to these types of changes and understanding how they might impact the families that we work with. So again, we'll be paying particular attention to these things and how they might impact your specific plan. So expect to potentially hear about some of these things as we get together for your regular discussions going forward. While also bearing in mind, again, that a lot of these don't impact all that many people. So you're going to have to be a little bit discretionary about who you talk to about what, because again, that broad ranging impact doesn't really exist here like it did in Secure Act 1.0. And so with that, we've reached the end of our prepared discussion materials for today. Did get a couple of questions that came through. If you've got any last minute ones, go ahead and get them typed in. We'll do our best to answer them if we don't run out of time. The first one I thought, James, might actually be best answered by you, since you covered this section. You talked about the ability to access retirement funds without penalty if certain situations, certain conditions are met. To be clear, does that also exempt you from the tax on those or just the penalty?
It does not, just the penalty. That's a good question. And one of those being the what I thought was not that great of a benefit once you realize that is to paying for like long-term care insurance. If you're still having to pull from a retirement account and pay the tax on it, is it that big of a deal that you can avoid a 10% penalty if you have to pay, whatever your federal and state income tax bracket are? There's probably better places to find that 2,500, but just my opinion.
Much to the dismay of the insurance industry, right? They might keep working on it. Who knows? We also got actually two questions on examples of prohibited transactions in IRAs. These don't happen all that often and are in some ways kind of obvious things, but just to give you a few examples, the one that I always think of the first, anytime this ever comes up, is if you put your primary residence in an IRA. You're living in a house, you're deriving direct benefit from that. That's not the kind of thing that you're supposed to have in an IRA. That's not retirement savings. That is textbook prohibited transaction. Don't do that, or you create big problems for yourself. Other examples would be borrowing from an IRA. You're not allowed to do that. That's why margin can't happen in an IRA. So if that's ever relevant, know that you can't do that. Also, things like buying collectibles. Interestingly enough, you're not supposed to do that in an IRA. You're not supposed to buy life insurance in an IRA. There's a slew of other things, but I'd say those are the more common ones that come up the most. So hopefully that answers that question. And I don't think we have any others. So I think we can go ahead and say goodbye. Once again, we want to thank each of you that took the time to go through our presentation today. Hopefully you found a couple of tidbits that might have direct applicability to your situation. And maybe you have a better understanding now of what you don't need to worry about that's happening in the new law. Because again, there's a lot that just won't impact things. So if there are any questions that you think of, or for those of you watching the recorded version of this, any questions that come up, we're always available to answer those. But again, one more time, thank you for joining us today. We'll go ahead and say goodbye. Thank you, everyone.